Hi, it's Monday the 6th of February and this is James Sugg with Westpac London's end of day report. A little bit of negative sentiment crept back into markets today after a very decent run to the upside, particularly for equity markets of late. I think it's largely related to ongoing concerns about the Greek debt negotiations. Nothing really concrete has yet emerged. We're getting closer to the point where potentially we could see a default, disorderly default by Greece in March. We keep hearing that agreement's almost being reached, but then nothing's formally announced. So when you're in the hands of European politicians, I suppose you shouldn't hope for too much. Anyway, that's the view that markets are taking today. The data today was mixed. We had, can't get used to these glasses, we had a sharp rise in Centix investor confidence for Europe in February, but that matched or backed up the message from the much stronger ZEW analysts survey from a few weeks ago. Equity markets have been doing better in Europe, and it seems related to that, unsurprisingly, investor confidence has been doing substantially better. We think it could actually be related to a sneaking expectation that the ECB is in fact getting closer to doing a more substantial form of, building a more substantial form of bond purchase program. They've already done €500 billion worth of effectively quantitative easing by lending to the banks, some of which is being spent on bonds. They've got their own little bond purchase program going as well, although they sterilise that. They've got another $1 trillion maybe worth of long-term refinancing to be done at the end of February. Tie that together and tweak it a bit and get Draghi to convince a few of his German colleagues, and you could actually envisage the ECB doing an unsterilised trillions worth of sovereign bond purchases not too far down the track. And I think that's one of the factors that's been boosting markets and indeed investor sentiment. We do seem to be edging closer to the possibility that the ECB could in fact go down that path. Nothing formal on that today, but that just seems to be the underlying vibe that's coming through in markets. German factory orders were up 1.7% today, but that went nowhere near like reversing the 5% fall in the previous month. Foreign orders are up, but domestic German and other European orders were down in those December figures. No US data to report, but we had Bullard from the St. Louis Fed, who was one of the ardent supporters of QE2 when it was announced back in late 2010. He's saying that the recent run of upbeat economic data in the US really doesn't justify a further round of quantitative easing. So you got one of the doves from 2010 this year saying no more QE, although he doesn't actually vote on the FOMC this year. Boeing having a few more problems with their 787. Something to do with lamination or delamination. Don't know the detail on that, but I know Boeing's share price, and that's one of the reasons why the US market is down. But really it's about Europe, as I said earlier. At the close, the FTSE in London down 0.15%. We've got the French market down 0.2%. The Germans pretty much unchanged, however. And the Dow heading into US lunchtime down around 1/3%. On the commodity markets today, we've got oil prices down 0.75% at $97.15 a barrel. Copper's also down 0.75%, and what the hell, gold is too. Well, actually down 0.8%. Gold's at $1,726 an ounce. The Aussie dollar, it's at 1.0737 against the US dollar. That's just a little bit softer than its recent peak of just around 1.08, but certainly still looking very solid. And against the euro, 81.86 euro cents is now what you get for one Aussie dollar. The Aussie's creeping ever higher against the euro. It's the Reserve Bank of Australia's interest rate decision today, Tuesday, Sydney time. So we're sticking with our call at Westpac for a further quarter point cut. Yes, the numbers in the US looked a little bit better. European markets are certainly a little bit more confident, but there still are a lot of risks out there. And given the degree of tightness that the Reserve Bank has removed in the last couple of easings, has really only brought rates down to around about their long-term average, or perhaps a little bit lower. the risks associated with them moving one more quarter at least, we would argue, are not that great, given the extent of downside risks that are still out there in terms of what's happening in Europe, related to the US economy, and even China as well. And the Australian inflation outlook remains pretty benign. So we're going for another quarter point cut. I think of the 17 analysts that are surveyed, 14 are in the rate cut camp. Okay, we'll have more on that tomorrow.